fraud investigative division and what goes into doing a private investigation for fraud. And this could be a small fraud against your business. Maybe you were scammed out of money by some online Ponzi scheme. It could be even money stolen from your family or from an estate. We're going to get into a lot more on the real estate market. There's some developments of what to expect over the next year or two. We're going to talk about cyber attacks, and this is an increasing risk, not only for businesses, but also for individuals. There are thousands and thousands of cyber attacks, and the troubling story is how long it takes to discover them once they happen. Sometimes they lurk in the background for many, many days, sometimes even months. Of course, we'll talk about auto sales and what's happening with the new and used car markets. And last, we'll take a look at a very troubling development in AI, where AI may be taking over some areas. So jumping right in, let's take a look at investigations. And this is something that we know a lot about. We do a lot of cases with fraud investigations. And here's a story where $8 million was stolen from a car dealership. And this is not a new car dealership. This is not like a Ford store or Toyota store. This is a used car lot. And this person stole $8 million. Now, you may not think this applies to you, but all of the same elements that go into a fraud of $8 million, a theft or embezzlement, go into any other kind of theft. So if you're a small business and somebody steals from you, if you're a family and some family member steals from you, if you are even scammed by some online fraudster, it's all the same elements. And we'll talk about how to identify it, prevent it, and also to recover if you're a victim. So this case, a couple pieces of information. This person named Mark Exposito, allegedly, he quit this dealership in 2019. And this is an important factor because this happens a lot with dealerships or with businesses and even with individuals. The company had fallen into financial distress. Well, think about it. If somebody stole $8 million, you would have financial distress. But the problem is they didn't know it when the person left. They just thought their business was having trouble. This incident is part of a pattern that had a span of over 40 years. So if you take $8 million over 40 years, it's not a lot every year. It's tens of thousands of dollars, but it ate away at that business. Mark Exposito and an accomplice depleted the company's bank account, siphoning off $8 million to fund their extravagant way of life. And that's an important thing to recognize, extravagant way of life. So what goes into a fraud? Well, a fraud always results from three elements, which we call the fraud triangle. The fraud triangle is a roadmap of every single fraud, scam, theft, embezzlement that happens. All three of these things have to be in place. And if you eliminate any one of them, you're going to be immune from fraud. What is the fraud triangle? First, the fraudster, the stealer, the scammer has to recognize that they have the ability to steal the money, take the money. And you may not think that's a big deal, but in many cases, that ability is the first domino to fall. We've seen cases where there's an employee in a company, a bookkeeper, salesperson, manager, and never thinks about stealing, never thinks about embezzling from the company. Because in most cases, the employee thinks there's no way I can steal because I don't have access to the checking account, or I don't have the money, or they don't see the pathway. And what happens is they find out accidentally that they could steal. For example, we had a case where a bookkeeper went to go pay for gas for their vehicle, personal vehicle, and accidentally used the corporate credit card at the gas station instead of their personal credit card. And they realized it right away and they got scared. Oh my God, people are going to think I'm stealing money. They didn't mean to. But since they were the bookkeeper, they figured they'll deal with it later. Well, nothing ever happened. Nobody ever noticed it. And they realized that was the first leg of the fraud triangle, is nobody is watching. Nobody is observing. A company should have best practices in their company that identifies and prevents these things from happening. Maybe somebody else looks at the credit card bills. Maybe the owner opens the mail. Maybe you have two parties sign off on checks. There's a series of best practices that any company or even an individual can have, for that matter, that will keep fraud from happening. And step one is the fraudster or scammer realizes, wait, I can do this. You have the availability, the opportunity to do it. But that by itself is not enough. A scammer is not going to steal money just because they know that they can. They have to have two other elements. Number two is they have to have a need for the money. Sometimes that need is have a medical emergency, medical expense. Their kid needs a $40,000 operation. Now they have a need for it. Sometimes the need in this article tells what the need is. Sometimes the need is pure greed. Fund an extravagant way of life. This person wanted an extravagant way of life. That was their need. Sometimes the need is I got arrested and I need money for legal fees. Sometimes the need is my car transmission blew up and I need $2,000 to fix it. Right? The need can come from a lot of places. So that's the second leg of the fraud triangle, is the need. First, you have to have the ability to know that you can take the money if you wanted to. Second, you have to have a need to steal the money, to use the money. And it could be pure greed. But 99% of the time, even with those two things, the fraudster, the scammer, doesn't go through with it. They need the third leg of the fraud triangle, and that is some justification, some reason that this is okay to do. Let's say you have an honest employee. They would never steal. They realize, oh, gee, I found out I can steal. I found out no one's watching the credit card bill. I found out no one's paying attention to the checking account. But they don't steal. Well, my son needs a $10,000 operation, so I have the need. They still don't steal because they're a good person, or they feel like it's wrong. But then something happens. They get passed over for promotion. They're mistreated by the boss. They hire somebody that gets paid more than them, new employee. Now they have a justification. Well, I have the right to do this. I'm justified. They deserve it. And they go through with it. That's the third leg. Sometimes it's feeling like no one's going to, it doesn't harm anybody. Like when you steal from an insurance company. Well, it's just a big insurance company. They'll just write it off. That's the justification. For a pure scammer, fraudster, their justification is, if you're too stupid to let me steal your money, then you deserve to lose the money. Right? That's an easy one. That leg of the fraud triangle exists in some psychopaths and scammers before anything else happens. That leg is already there. It's built into their morals. But even people who are honest and moral sometimes succumb to stealing. So as a business person, you can prevent a good person from going bad by not giving them the opportunity. Don't, leave, money out where they could steal, right? Figuratively. Now, what about in your personal life? Well, people steal from you all the time. You may have a family member that needs money. And if you prevent them from stealing it, you can prevent them from being their own worst enemy. I'm not saying it's victim shaming. It's not your fault that they steal, but you can help a person that could go either way from going down a bad path by not making it easy for them. And also cultivating the relationship so they don't want to do that. Don't give them the justification. At the same time, if you know that people around you have a lot of needs, like there's a lot of people around you with debts that maybe have financial crisis in their life, that's something that could have an effect on you. If you put them in a position where they could take money, and then even if they perceive to be mistreated, they could steal money. So the fraud triangle is something you can use to eliminate any one of those steps to keep somebody from stealing from you. Look, if one of the requirements is the person have justification, have bad morals, just don't be around people with bad morals. They're not going to steal from you. If you are worried about people convincing you to voluntarily send them money, like for some fake investment, and you're not sure if that's going to work, maybe you have a rule with yourself is before you send money that you bounce it off another person in your family or a trusted friend. Hey, look, this online investment, they want me to send them $100,000. What do you think? Right? You put things in place that eliminate that. Don't fly solo. Don't go on your own. Make it less likely that you're going to lose money, because some of these cases are tragic. We talk to people every day who have lost tens or hundreds of thousands of dollars, their hard-earned money, to some scam. Somebody online tells them, send me money and I'll double it in 2 months. They get greedy and they lose their money. Or they are in a divorce and the other party hides money. That justification is already there. Or there's a death in the family and you're supposed to get an inheritance, and one of the other people in the family or a family member or friend takes some of the assets and hides them before you even know about it. Those are all same kind of frauds, same kind of scams. So we see this all the time. There are ways to undo them by using the same fraud triangle. If you know the person has the ability to steal, you find out what pathway they used, which method they used to steal the money. If you want to know who did it, find out the person around you that had some recent sudden financial stress or an extravagant lifestyle that all of a sudden came out of nowhere. Those are ways to solve these kind of crimes. So next we're going to talk about cyber attacks. It's another form of loss, another form of damage where a scammer or fraudster is attacking companies and holding them hostage. And we're going to compare that to other kind of risks. If you're a company business owner and you are considering what are your risks, you probably have insurance for many things like fire on your building, slip and fall in your premises. What is going to happen if there's a cyber attack, and what are the odds compared to some of the other types of losses? So look for that in about 30 seconds. We'll be back on the other side. All right, well, that was fast. So here's the thing. In any business environment, you have certain insurance on your business. You probably have a fire insurance policy. You probably have a premises liability policy. You may have E&O insurance, professional liability insurance, all kinds of insurance. When have you ever had to use those coverages? Probably very rarely. And if you have colleagues that are in business, they probably don't have too many losses either. But you may or may not have cyber insurance, cyber protection insurance, cyber liability insurance, call different things. If you don't, call your insurance agent and ask them about it. Here's why. What do you think the chances are of your building burning to the ground? Right? What are the odds? There were only, across the whole country, about 100,000 corporate business property fires last year. Sounds like a lot, but divided up over 50 states, big cities, it's not a ton. There were 400,000 residential fires, but only about 100,000 commercial property fires. The reason is that commercial properties have a very low fire risk. Yeah, if you're manufacturing flammable items, maybe. But you have fire insurance more than likely. The question is, do you have cyber insurance? Well, you probably don't. There's less than 15-20% of companies have it. However, there were more cyber attacks against companies last year, more than 100,000, than there were fires, but less coverage, right? Here's the other thing. You have a fire event at your business or your home for that matter, you know about it instantly. You don't have to wait a certain period of time to discover that loss. The loss happens, the building's burning, you can see it, it's covered. A cyber event, the average amount of time to discover the intrusion is 212 days. So what these hackers do is they attack your system, they get inside your server, in your email, in your network, and they just gather information for months, 2 or 3 months. And then they use that to formulate an attack vector, a battle plan. They'll hack your email, send emails to your clients to have them send payments to the scammer. They will use information about your HR department from your employment records to get maybe a manager to give them a password. They'll use this information and go on social media and contact people there to completely lock down your system. And then what happens is you come in your office one day and all your computers are all shut down. They're all locked up and they have a password on it. And then you get contacted. If you pay us $10,000, $20,000, we'll release the password. Ransomware. Or they'll take your customer list and they'll sell it to a competitor or on the black market, the dark web. Or they will get your customers to send their payments to somewhere else. They'll use your email, they'll have your logo, they'll have your email signature, and they'll tell all your customers, hey, we changed banks. Send all your payments for your accounts payables to this new bank. And for a few days or a week go by and all the payments, all your income goes somewhere else. How are you going to get that back? You're not going to go to your customers and tell them to pay again. It wasn't their fault. They're not going to pay again. In fact, even if you eat the money, a lot of customers are going to be very concerned about your internal security, and they might go to another business. They might think that, their confidence is shaken. And even if not, during the time you're shut down, a week, 2 weeks, if people can't get a hold of you, they're going to go somewhere else to buy a product or service. So ransomware is a big deal, and there's other risks as well. The good news is because of the fact that this new type of loss is becoming more common, the rates are dropping. Cyber insurance rates dropped last month, 10%. Another evidence of this is E&S market is overwhelmed. Well, what's E&S? E&S stands for excess and surplus lines. Excess and surplus lines. What that means is these cyber policies are so customized that they're not standard off-the-shelf boilerplate contracts like when you buy a standard business owner's policy or a commercial package policy. The language is the same for every company. The insurer, the major carrier, let's say like Chubb, goes to the insurance commissioner in your state and they tell the commissioner, look, we want to sell this business policy. Here's what the terms and conditions are. Here's our rates. And they get approved as what's called an admitted carrier. Admitted carrier. That means that they are authorized in that state. Well, that only works if they sell a lot of the same policies. If they write policies that are very customized, unique, not a lot of volume, now they have to become what's called an excess and surplus lines carrier, which means their policies are not admitted, they're not reviewed. Doesn't mean they're bad. It just means there's not enough of them to have a standard market. So the E&S market is being overwhelmed. What that means is that there's a lot of excess type custom policies. The property and casualty marketplace does not have the capacity to take demand from clients. More policyholders are going to E&S industry, right? This is a big deal. And this is a quote from Gallagher, one of the largest insurance brokers. The E&S market has been able to absorb this demand, and London carriers, these are the reinsurers, have stepped up to the plate. More and more risks and losses to businesses especially are going to be attributed to new types of losses that didn't exist 10 years ago. These cyber losses didn't exist 10 years ago. So if you're an insurance company, you know how to write fire policies. Fire policies existed since the 1800s. So they know how to write those. They know what the risks are. They know the underwriting, terms and conditions, exclusions from coverage, endorsements. Cyber policies have only been around for 5 or 6 years. Plus, they change every year. These hackers come up with new schemes every year to try to overwhelm the victims. So that's what's going on with insurance. So no matter what size your company, even if you are a medium size, um, domestic residential family, you might want to look at if there's cyber insurance available to you um, that can protect against some of these. What's next? Well, obviously, it's like a broken record. You hear about it from us. Housing market. Everybody wants to know what's going on with the housing market. In fact, that's a good headline, right? And that's the headline that we saw this morning. Headline is, what the heck is going on with the housing market? Housing market is still surprisingly tight despite mortgage rates at 20 years high. Demand is high and supply is low. Well, it's not surprising to anybody who watches this channel because for more than a year, we've said, doesn't matter what happens with rates or anything else, demand is going to be high and supply is going to be low. And a lot of people think that supply and demand would change the housing market. In some ways it does. But here's the problem. Demand doesn't go down. For discretionary items like a pair of socks or maybe new cars or boats or RVs, demand goes up and down because nobody needs those things. Nobody needs an RV. Nobody needs a boat. Nobody needs furniture per se. You have furniture. But a house, everybody needs a house. So whether you rent it or own it, everybody needs to have a house. The number of people that needs a house is not going down. In fact, there's millions of people living on the streets because they don't have a house. So the demand is always there. Now, can you afford the demand or not? We'll get into that. The demand is always going up. Demand does not go down. Now, the appetite or the budget may go up and down. But in reality, when does anybody's budget ever really go down? For a house, nobody expects, well, I'm going to pay less for a house this year than last year. Everybody expects that house is going to cost more next year than this year. There was a housing decline. Some people call it a housing crash in 2008. That was an anomaly that had nothing to do with the market, had to do with the fact that it was artificially built up because too many people bought too many houses. It wasn't one-to-one. It wasn't one person bought one house. There were people that bought 5 or 6 houses with adjustable rate mortgages and rented them out or flipped them or whatnot. If it was a one-to-one ratio, it would have never happened. Supply goes up when houses are built. That's it, right? There's no other reason that supply goes up. Even resale homes, the supply does not change. The number of houses that are out there, right? You can see this picture of this. We'll use that as an example in this article. There are 1, 2, 3, 4, 5, 6, 7, 8 houses in this picture. For the next 50 years, there will be 8 houses if you take a picture in the same place, unless one of them burns down or something happens. There's always going to be the same number of houses. The supply does not go up and down. The available supply may change when people decide, I want to sell a house. I want to move. I've died and I got to get rid of my house. That may change the available supply. But what affects that? That's affected by the number of people that want to move. I want to move somewhere else. And some people do. But right now, as we've talked about, it's hard to do when you have a 3% mortgage and your new house is going to have a 7% mortgage. So a lot of people are not moving. Even if they were, they have to buy another house. So it's like musical chairs. You sell one house, you buy a house. There's no new house created in that transaction. There's no new supply created when a person moves from one house to another. They either move up, they move down, right? In fact, more people are moving from apartments into houses than there are the other way around. So the number of houses to buy is always going down. Now, you may say, aren't they building houses? Yeah, they're building new houses. Not fast enough to keep up with demand. In fact, the backlog has reached 5 or 6 million over the last few years, and it's almost impossible to catch up with the backlog. So to ask what the heck is going on with the housing market, it's pretty easy to see. Now, remember, take everything with a grain of salt, consider the source. But, one of the high profile people in the real estate industry, Barbara Corcoran, Shark Tank member, says housing prices are going to go through the roof. And says when. Why does she say that, though? If you're a prospective homeowner, you're in a tough spot. You may be tempted to wait for interest rates to drop. But if you wait too long, you could be waiting for a surge in home prices. Now, granted, she may have a bias because she's in the real estate industry, although most of her business enterprises now is not in real estate. Lower interest rates will mean higher home prices if interest rates go down, which they may not. The Federal Reserve announced they're going to actually raise interest rates. But what if they don't go down? What if interest rates go up even more? Well, housing prices still probably won't go down because the same number of people are still needing to buy a house. Just because the price went up doesn't mean you buy less house, right? If the price went up, you're either going to find a way to afford it or you're going to move to an apartment. And that apartment is going to be also taking away a housing unit where somebody now has to move to a house. It's not an elastic market. In fact, think about this. If you fill your tank up 4 times a month to go to work in your gas tank of your car, and gas prices go from $2.50 to $5, are you going to fill your tank up less and not drive to work? You still have to get to work. You might not take as many trips to the grocery store. You might not make as many trips on vacation, but you still have to get to work. You're going to buy about the same amount of gas. So you can make some adjustments, but you can't eliminate it. You can't eliminate totally a house. Either you have a house or you don't. Maybe you buy less of a house than you imagine. Maybe you you shop for something that's below what you thought your dream house was, but you don't not buy a house. In fact, that's supported by another article from people who are saying homeowners are planning to buy again in the next 5 years. There's no buyer's remorse. A quarter of homeowners expect to buy a new home over the next 2 to 5 years. Those seeking new homes could secure mortgages with low interest rates in the pandemic, but they're saying the market is different. Many homeowners purchase a home smaller than they thought they would need or fixer-upper, and now, after 2 years, no capital gains tax, they're going to buy another house. So the people who did buy a house, even during the housing bubble, if you can call it that, really aren't regretting it. They still want to buy a house. Maybe they want a different house. Maybe they're looking to do something a little bit alternative, but it's not like they wish that they didn't buy a house. So we're going to take another quick break. When we come back, we're going to look at some very surprising data from the housing market. From the automobile new car market. And then we're going to look at AI. And what is AI doing? There's a huge warning from one of the developers of AI that could be basically almost like a meteor hitting the earth. It's game over, lights out for society. But not to do too much clickbait or too much, sky is falling. We'll get to that here in a minute. All right, we're back, and we're going to talk just for a minute here about the automobile market because just like the housing market, people expected, car sales are going to crash, right? And many automakers are reporting highly record sales. And here's an article from the Wall Street Journal: auto sales defy gloomy forecasts. Dealers and car executives um, are reporting 12 to 14% rise in new vehicle sales for the first half of the year, far ahead of forecasts. Even the industry didn't think it was going to be that good. Some of it's pent up demand. And the other part, which is kind of related to pent up demand, is when the factories weren't building as many new cars in 2020 and 21, there weren't as many late model used cars out there. So there's actually now a shortage of used cars, which means people are there is a kind of lurking, maybe, I don't know, fear of EVs because of the fact that a lot of people are seeing the EVs are starting to take over. Some car buyers are wanting to buy a gasoline car while they still can, because some states are outlawing gasoline cars, internal combustion engine cars, in the next 4 or 5 years. You can't buy one. You can only buy an EV. So some people want to get in now while they can, so they have a newer car if that happens. One question: if you are looking at the EV market, do you think that electric vehicles are going to go the way that diesel vehicles did back in the 80s? Now, I'm not talking about diesel trucks. Diesel trucks are a different animal altogether. They need the torque to haul and tow. But in the 80s, there was a flurry of diesel vehicles. Even General Motors, Oldsmobile, Cadillac came out with diesel passenger cars. And they only lasted a couple years in the mid 80s because there was an oil crisis and gasoline prices were going up. And diesel cars got better gas mileage. Instead of getting 27, 28, they got 35 to 36. And diesel fuel was cheaper. And at one point, diesel cars represented about 5 or 6% of new cars sold. And even into the 90s, there were diesel Volkswagens and Mercedes and some other European cars. But it never really took off as a big percentage. And now it's kind of faded out. Diesel cars are not really a big deal. Trucks separate, not talking about trucks. So do you think now that electric vehicles are seeing this resurgence, they're now getting 4, 5, maybe 6% of the new cars sold, kind of like diesels, do you think it's going to flame out, be a flash in the pan, and go away? Do you think that electric vehicles are just a fad? Now, there's one difference. In the 80s, the manufacturers said, let's try diesels on the side of gasoline vehicles and see what happens. They never completely committed to it. The government didn't mandate diesel vehicles. Manufacturers today are almost abandoning gasoline vehicles. So that's a difference. Even though the percentage is about the same, there's more behind the scenes hollowing out of the gasoline car market. In fact, even 3-4 years ago, Chrysler announced they're not doing any more new engineering, research, development of gas vehicle engines. They stopped. They shut down their gas vehicle engine research department. So there'll be no new types of gas vehicles coming out. They did this 3 years ago. Only electric, focusing on electric. That didn't happen with the diesel fad. They still built plenty of gas cars. And as soon as diesel started to become not popular, they just abandoned it, and they had their gas car production already, still in process. So that's one difference. The other difference is people actually liked diesel cars back then. There's a lot of fans of diesel cars. In fact, there were some diesel cars that are a cult following. The 80s, mid 80s Mercedes 300 SD and 300D, those are cult following. You can find those that have 5, 6, 700,000 miles on them. People still like them today. Some are converted to, the diesel that runs on French fry oil. So do you think there's a parallel? The percentages are the same. The growth is the same. The difference is behind the scenes, or seems like there's a whole bunch more of weight behind EVs from the powers that be. So do you think that there's something that's going to happen to make EVs be a fad, or is it here to stay? Our last subject is going to be about artificial intelligence. And we're going to pull up some data about how All right, here we go. So artificial intelligence, there's a lot of warnings coming out, and you got to consider the source. Some of these are a little bit conspiracy theory type places, but some are mainstream news. This one is talking about the threat of unmoderated chatbots. The ongoing debate about artificial intelligence couldn't get stranger. The New York Times ran a feature article about some of the new kids on the block when it comes to AI chatbots. In some cases, they have removed all of the guardrails installed on bots. By guardrails, meaning that they put limits on what they can talk about, limits on their content. But now they can speak freely, even if that means the bots are dispensing inaccurate responses or even dangerous information. So the guardrails are removed. That's troubling. It's only the beginning of 2023. The CEO of the company behind ChatGPT, one of the largest chatbots, says the worst case scenario for AI is lights out for all of us. That sounds pretty ominous to me. Lights out. And this is the CEO of the company that makes chatbots, that wrote the chatbot. Chatbots are now teaching college students. Harvard University Unleashed plans to incorporate chatbots to teach a course. So you don't need a professor, you don't need an instructor, you just need a chatbot. Where's the information come that gives that virtual instructor its instructions? How does it know what to teach? Each of us has a certain opinion about whether we want to talk to an actual human or a machine. Sometimes if you go to the store, I don't want to talk to a person. I want to do it myself. Sometimes people are their own worst enemy. Sometimes people are an obstacle to getting something done. But is chatbot desirable or not? If you went to the drive-thru at McDonald's, would you rather be talking to an actual human or a robot? Which is better? The actual human might be, incompetent. They might get your order wrong. But then again, at least you can get their attention. You can grab them by the lapels and say, look, I want this done a different way. Depends on the execution. So far, and this can change over the next few years, what are your thoughts? What is your experience? What would you prefer? Talk to a human? Talk to a chatbot? Which is going to be more effective? Which is going to be more intelligent? Certainly the chatbot can't read between the lines and try to guess what you're saying, but they may know more. They have more access to knowledge. One individual person only knows so much in their brain. So you may ask a question they don't know the answer to. Chatbot knows everything because they have all the information, all the facts and wisdom from history at their fingertips they can access. So which is better? What are some reasons why chatbots are not an advantage that maybe people haven't considered yet? We'll talk more about that in other videos.
Are you tired of automated systems and chatbots when you need assistance? Experience actualhuman.com and connect with real professionals, not automation. At actualhuman.com, we bring you a network of professionals who are excited to answer your questions and provide guidance. Getting started is easy. Let us show you how. Here's how it works. Step 1. Select the best date and time for your video call. Step 2. Describe your situation and the areas you're looking for advice. Step 3. Connect one-on-one with an expert and get the undivided attention that you deserve.